Bank of America Merrill Lynch out with a bold call this morning, calling for 7 rate hikes this year. Concern is that could weigh on growth. Let's welcome the economist behind this report, Ethan Harris. Ethan, you're like the least provocative person I could think of. You know, if this came from anywhere else, I might just dismiss it. But from you, I take it quite seriously. So what's changed in your mind here?
I mean, I'm such a nice guy. I wear sweaters on TV. Yeah, I mean, listen, I think the Fed has finally admitted that they're behind the curve. It doesn't make sense to have a zero funds rate with how fast the labor market's improving. The unemployment rate's already down to 3.9%. It's still falling very fast. We obviously have seen some very high inflation readings, and they're persisting a lot longer than expected. So what does the Fed do about it? How do they catch up? The consensus is they go once a quarter. In my mind, that might have made sense if you hadn't had such a significant surge in inflation and such a tight labor market. But I don't get it in this environment. To me, an appropriate policy would be to start in March and then each meeting reassess, look at the data, which is going to remain strong, look at the inflation numbers, which are going to come down very slowly, and then hike again. And so I think ultimately they hike 7 times this year and probably a few more hikes in next year. But you can't catch up going once a quarter.
What's the risk that really slows the economy and then at that point they take their foot off the brakes?
Yeah, I mean, that is the main risk here. And it's been the risk of them waiting so long. Why not start hiking, a few months earlier so you can go even slower? Well, I do think it's a challenge to the equity market. I think the correction in the market in the last few weeks makes a lot of sense. I mean, the markets had blown through inflation warning signs, in part because the Fed told them, don't worry about it, and we're not going to react to it. It's not a problem. Well, it is a problem. And so the equity market has corrected from that rally. And as the Fed goes forward, the market's only priced in for this year about 4 or 5 hikes. So we've got 7 in there. And there's going to be a little bit more, rough moments in the markets. I don't think it's a bear market. I just think rough moments. The economy is much healthier, though, than that. I mean, the economy has tremendous momentum. Households are loaded with wealth and liquidity. The economy is not the stock market. And I think the economy will remain pretty healthy this year. And then by next year, we start to see more of a slowing as the rate hikes start to take a real effect.
I'm curious, Ethan, when, the reaction among most seems to be, when they see 7 hikes this year, they roll their eyes, they laugh, they go, this is crazy, no way, but what you're saying is not at all some extreme scenario or anything like that. It's why does this economy need that many hikes and need them this quickly?
It needs them because the Fed is so slow to react. They have a near zero interest rate with one of the hottest economies in recent decades. I think that the problem for the Fed is I think they're fighting the last war. They're trying to do what they did in the last business cycle, keep everything, the foot on the accelerator, keep the economy growing, push the limits on unemployment, and see if you can create some inflation. That was fine in 2018-19. It's not fine today. And they've had a bit of bad luck with the COVID crisis and the impact on supply chains and so on. But they're behind the curve. Frankly, the fact that I have gray hairs may partly explain why I think there'll be 7 hikes, and that's because I've seen it before. The last business cycle is the last thing we should be looking at, when they hiked slowly to 2.5 and then started to back off. As Powell himself said at the press conference, that episode is a poor analogy to today when there's actually inflation and high inflation expectations. So I don't view 7 hikes as being like out of the ordinary. It's just different than what people have experienced in the last decade.
So where does 7 hikes put the Fed funds rate at the end of this year?
Well, so they'll be just below 2%. They'll be right about 2%, which is, according to their own estimates, still below the historic norm. I think they still have a little ways to go from there. I do think that as they go further in the cycle and keep testing the limits, at some point they'll discover that they've hit the pressure point. But I think it's going to take a while. And I do think that we have to remember that when you're fighting inflation, if you're central bank fighting inflation, it can't be entirely painless. You can't treat the stock market like your best buddy. It has to be, you have to take some risks.
Yes.
And that's what the Fed is doing.
All right. Ethan, thank you very much. Ethan Harris.